In our last episode, we mapped the season. Today, we zoom into the problem set that forced reform, why America's banking system cracked so badly around the panic of 1907. Paul Warburg's opening essay, Defects and Needs of Our Banking System, is a blunt diagnosis. We had plenty of money on paper, but not the kind of reserves and market plumbing that turns stress into stability. The big idea is simple. Pre-Fed America had a fair weather system. Reserves were scattered, the currency was inelastic, and there was no central institution or discount market ready to turn good assets into cash on demand. Without a modern bill market, banks routinely leaned on stock exchange call loans as a kind of secondary reserve, fueling booms when money was easy and intensifying crashes when it wasn't. Warburg's fix starts with the mindset. Stop treating reform as a more notes problem and treat it as a reserve and rediscount problem. Build a central institution that can combine reserves and buy short-term two-name paper, including trade and bankers' acceptances, so credit can expand or contract smoothly as conditions change. Warburg's contrast with Europe is telling. In places with a central bank and a developed discount market, confidence holds because banks know that against good assets, good money will always be available. In 1907 America, however, the legal and market infrastructure wasn't there. When distrust spread, depositors yanked cash even though no gold drain or true currency shortage existed. The result exposed a system that worked only in fair weather. He lists the specific defects that magnified the panic: inelastic currency, useless reserves, no brakes to slow an overheated economy, no official channel to negotiate international relief, and no standardized American bills of exchange that banks could readily rediscount at home or abroad. In short, we lacked both the tools and the institution. That institutional gap also distorted everyday money markets. With no broad, dependable outlet for high-grade commercial bills, banks across the country dumped their idle funds upon the stock exchange, treating call loans and New York balances as their quickest secondary reserve. That practice made rates swing wildly, great in the boom, dangerous in the squeeze. And it blocked development of an open discount market where policy could work cleanly through bill purchases and sales. Warburg's essays and Seligman's introduction to them hammer this point. The United States needed to combine reserves and normalize rediscounting to replace the stock market safety valve with a real money market mechanism. So what did Warburg want readers and legislators to internalize in 1907-08? First, that a central bank was the ideal solution. Not necessarily as a monolith, but as a structure that could concentrate reserves, set a discount rate, and create a standing market for short-term trade paper. Second, that American bankers should drop their suspicion of acceptances and rediscounting. These were not exotic tricks, but the core instruments of a liquid modern system. Get those two pieces right and you transform crises from cash panics into manageable credit adjustments. If you remember one thing from today's episode, make it this. The old system didn't just lack more money, it lacked the mechanism to move money to where it was needed when it was needed against sound collateral. Warburg's answer: combined reserves and a genuine discount market became the backbone of the Federal Reserve. Next time, we'll start building the cure. From central bank sketches to a United Reserve Bank plan. If you want to read along, grab Paul M. Warburg's The Federal Reserve System, Its Origin and Growth. Owning the book makes it easy to mark the passages we highlight and follow the argument from panic to policy